Unlocking the Indian agri-sector through supply chain finance. Big changes are essential for big ideas to flourish. The Green Revolution, which in many ways was our first moonshot to greatness. It did not happen until we changed the way we produced our food, which propelled us from a ship-to-mouth existence to self-sufficiency in a relatively quick time. Today we are among the top 3 producers of some 24 major crops and dairy produce. But farmers are yet to see any major breakout from living on the edge. Despite contributing less than 20% of the national GDP, nearly 55% of the country's workforce is employed in agriculture. During the 7 years between 2012 to 2013 and 2018 to 2019, the average monthly income of a farm household recorded a modest growth from around 6,500 rupees to 10,200 rupees. The biggest challenge faced by India's agriculture sector is that nearly 9 out of every 10 farmers in India are small or marginal ones, i.e., hold less than 2 acres of land each. Absence of economies of scale brings home many challenges affecting the overall productivity of small and marginal farmers. The most persistent one is the lack of formal finance. The situation is further accentuated because typical farm produce goes through several intermediaries between the farm and fork, including traders, processors, and retailers. These participants, which are generally categorized as micro, small and medium enterprises, MSMEs, are a significant part of the country's rural economy. According to the draft National Policy of MSMEs, there are more than 6 crores of them, and a good many of them don't have access to formal banking. Supply chain finance, SCF, may offer a solution. In developed economies in Europe and the US, where nearly 90% of funding is backed by some or the other form of guarantee funds. In India, such schemes have seen little success as the overall creditworthiness of SMEs is precarious and difficult to assess for lack of formalization. This results in agri-dependent MSMEs seeking informal, local sources of finance that come at an exorbitant interest cost. Further, agriculture supply chains not only have many more participants but also depend on various external factors. The first 2 legs of the supply chain, i.e., farmer to commission agent and commission agent to trader processor, lack collateral, which the traditional banking system requires. Lack of liquidity adds stress to the entire supply chain. SCF may bring stability and flexibility to these agriculture supply chains by bringing the lowest cost of capital to where it is needed most. A customized and demand-based credit will shift the focus from survival to improving efficiency, aid innovation, and investment in newer products and methods of farming. This may increase the yield and income of farmers. Since SCF is a form of metered credit which is linked to actual trade transactions and cash flows of borrowers, designing and delivering appropriate SCF products can leave a positive imprint across the agricultural chain. Traditional SCF has a scope of wider replication for cases like dealer finance to retailers and distributors to provide liquidity support and extended credit to them. Payable finance for traders to pay farmers and commission agents on time. Sales bill discounting for traders to receive early payments for sales to reputed corporates resulting in immediate liquidity. Farmer cards, which can be used by farmers to pay for inputs and fertilizers and also to receive payments in the card when they sell their produce, leading to cashless transactions. Newer credit models are being tested across various pockets of the country. E.G. Farmer Producer Organizations, FPOs, are forming joint liability groups, JLGs, and solving for repayment guarantees and creditworthiness for member farmers. JLG models, which were made successful by MFIs, are now being adopted by banks to extend credit to the farm sector. The availability of verifiable KYC data today, coupled with lenders' ability to access and assess actual transaction data between buyers and sellers, provides a strong alternate mechanism to manage credit risk both whilst onboarding borrowers and while monitoring them through the life of the loan facility. Such customized SCF products that differentiate themselves from formal banking address many of the endemic challenges faced by Indian agriculture, including the cost and speed of finance, ability to service without collateral, address seasonal demands, and define end use to prevent misuse of funds. Injecting SCF into Indian agriculture can unleash stronger and sustainable growth in the primary sector. According to the Reserve Bank of India, for every 1% increase in real agricultural credit, real agricultural GDP increases by 0.22%. Further, farmers who have access to formal credit on average earn 17% more than the ones dependent on informal credit. For far too long we have allowed the fortunes of our farm sector to be swayed by way too many uncertainties. The lack of reliable sources of credit that come with reasonable conditions is perhaps one of the biggest challenges faced by our rural economy. This can be fixed by changing the way we finance the entire ecosystem. Perhaps SCF is the solution staring at us in broad daylight. Source: article by Chief Credit and Risk Officer of Vienna Network in Times of India, 14th November 2022.